The gold price has been climbing to record highs. It's currently at over $3,600 per ounce, nearly double its value since 2023. And year to date in 2025, gold is up about 35%. In comparison, S&P 500 is up 11% year to date. Nasdaq 100 is up 13%. In this video, we are going to break down the key drivers behind gold's rally and share with you my top picks for the gold ETFs. Several powerful forces has converged to drive gold's rally. First of all, we have the inflation hedge. Since the pandemic, Federal Reserve have pumped a lot of liquidity into the system, causing a multi-year high inflation problem, eroding the purchasing power of the American consumers and the US dollar, and driving a lot of investors to buy gold as a store of value. Despite many years of Federal Reserve trying to get inflation under control using monetary policies, the CPI recently have went upwards. The core CPI year over year is 3.1%, and overall CPI is at 2.7%, both above the long-term 2% target. Another thing boosting gold price is the interest rate and Fed policies. So because gold offers no yield, its attractiveness increases when interest rates fall. Recently, a weak non-farm payroll job report has fueled the expectation that the Federal Reserve will have to cut the interest rate in the next FOMC meeting. So markets are pricing in a 92% probability of a 0.25% rate cut in the September 17th meeting and a 8% probability of a 0.5% rate cut on that September meeting. Investors are also expecting to have at least one rate cut for the remainder 3 meetings of 2025. So lower interest rate reduce the opportunity cost of holding gold, enhancing the attractiveness of gold. And they also tend to weaken the US dollar, making gold cheaper for foreign investors because gold is priced in US dollar. And when the US dollar is cheaper, gold appears to be cheaper for foreign buyers. Another key driver of gold's rally is the challenge to the Federal Reserve's credibility. When the market perceives the Fed's independence is being challenged, gold often becomes the preferred safe haven asset. Recent development, such as attempts to remove Fed Governor Lisa Cook and the chairman Jerome Powell, highlights the risk to the credibility. A loss of confidence in the Federal Reserve will undermine the trust in the dollar, weakens its value, and in turn make gold more attractive. Another driver is global uncertainty. From geopolitical conflicts to trade tensions and mounting recession risks, global uncertainty remains elevated. In such an environment, gold thrives as an alternative safe haven asset. Unlike the fiat currency, which are tied to government and have throughout history been devalued, collapsed, or replaced as the kingdoms vanish, gold, on the other hand, has stood the test of time. For over 3,000 years, it has served as money and store of value, independent of any government authority. Another powerful driver of gold's strength is aggressive central bank accumulation to diversify away from the US dollar and treasuries. Central banks has been buying gold at an unprecedented pace. In 2024, they have added over 1,000 metric ton of gold for the third consecutive year, marking a historic surge in official sector demand. On paper, the global central banks now collectively holds 36,000 tons of gold. For the first time in 30 years, their gold reserves exceeds their US Treasury holdings. But actually, many gold purchases by central banks are unreported. For example, for China, official holding stands at about 2,300 metric tons, but analysts estimate the actual reserves could exceed 5,000 tons, more than twice the reported figure. Now let's discuss about my top pick for the gold ETFs. There are 2 ways for people to buy gold. One is to buy physical gold, another is to buy ETFs that are backed by physical gold. So, which is my preferred method because of the convenience, right? You don't have to worry about buying and selling and liquidity and having to store gold somewhere. If you put it in a bank, you have to pay an ongoing fee. But if you go with an ETF, you don't have to worry about all that. So the first ETF is the SPDR Gold Shares ETF, ticker symbol GLD, issued by State Street. It's the same company that issued the top S&P 500 ETF, the SPY. And GLD have an expense ratio of 0.4%. It's the largest and the oldest gold ETF. The inception date is 2004. It's managing $112 billion in asset. Number two, we have iShares Gold Trust with ticker symbol IAU, issued by BlackRock. It's the second oldest gold ETF, issued in 2005, holding $52 billion in asset, have an expense ratio of 0.25%. Number three, we have SPDR Gold Mini Shares with ticker symbol GLDR, right? It's a cheaper version of GLD. It's issued by the same company as GLD. It's State Street. And with an expense ratio of only 0.1%, have an asset under management of $19 billion. Inception date is very young. It's 2018. And then we had number four, iShares Gold Trust Micro ETF, ticker symbol IAUM, issued by BlackRock. It's the same company as IAU, okay, and it's much cheaper. It's the expense ratio of 0.09%, managing $3.7 billion. The inception date is even younger, 2021. So as you can see, there is a ongoing beef between State Street and BlackRock for their gold ETFs, right? So State Street made their first one with a 0.4% expense ratio, and then the BlackRock made IAU with a cheaper fee. And then a couple years later, State Street made an even cheaper version with 0.1%. And then have BlackRock made another one is even cheaper, 0.09%, right? There's an ongoing beef between the two companies, and this competition actually have driven the cost down for the investors, directly benefiting us. And these two ETF issuers are both among the largest ETF issuers globally and have decades of proven experience across different asset classes. So for long-term investors, I believe the GLDM and IAUM are the best because, first of all, they both, like I said, have the best ETF issuers, so their products are reliable. Number two is they have ultra low fees, which will make a significant difference over a long time for long-term investors if you consider the power of compounding. Thank you very much. Please like and subscribe.